Hello, ladies and gentlemen. I'm Joseph Novichkov, Senior Trading Manager with GDM. Welcome to our first webinar series for this year. Today's session, we will talk about a very simple 15-minute chart swing trading system. But before we get on with the complexity of the system itself, first of all, I wanted to revise a few details on the past 1 year. What we saw so far on the market was an interest rate increase from US Federal Reserve to 0.5% or 5 basis points. Now, another thing we saw last week on Friday, to be precise, was the adoption of negative interest rates from the Bank of Japan. Also, what we saw is major market turmoil in the Asian sector. Now, what I mean by that is China, as the second largest economy in the world, is experiencing a downward direction in its economic expansion. What does that mean for the market? The markets, it's in this particular moment. Well, one thing is for sure: everyone will be chasing after risk potential, or the so-called safer assets, such as gold, silver, the yen, the euro, and many other instruments that you can find on our trading platform, with tight spreads, of course. However, what is important here to understand, ladies and gentlemen, is the investors' sentiment throughout the whole year, not only quarter by quarter. It's what we spoke on during our December webinars, when we actually talked more about the fundamental side of the market rather than the technical one. As you know, during that time we saw so many changes in the market, nearly a decade low interest rates from the Federal Reserve, which were holds until December last year. So right now, from the technical part of the market, we're seeing a little bit of a rebound from the recent downtrends, or the so-called cooling down of the market on the majors. Also, we're seeing a lot of problems in the energy sector, where we're strictly eyeing crude oil, as there is so much supply in the market and so many new players coming on the market that, you know, from the consumer standpoint, it is very difficult to achieve this equilibrium the market is looking for. So at least past the third quarter of this year, we're going to be witnessing cheaper oil prices. Also, probably at the end of next year, we're going to sustain some kind of, you know, stable prices. For now, there is a lot of risk on the market. There is, of course, a lot of profit potential to be made. So we, all of us, as traders, speculators on the market, we're not really interested in a certain upside of the market. We're actually interested in finding out what's the next direction. Basically, we don't really care if the market is up, down, or sideways. We have strategy for everything. We are prepared to take day by day the punches of any economy in the world by approaching it with the right strategy, the right money management system, and of course, the right risk approach. Stepping into this leads me to get into our session today, which involves not only the 15-minute chart, but involves from weekly down to 15-minute chart. So basically, It doesn't matter what our focus mainly is, whether 15, 30-minute or 1-hour chart. We have to pay attention to the larger time frames as well. Why is that? Well, first of all, because every strategy or every system for any trading plan accumulates past data to be able to project further future performance. So that means to start implementing the right way our new strategy, we need to go from the largest possible time frame. We're actually going to ignore the monthly charts because for this particular strategy today is not necessary for us to look at it. Basically, from the weekly chart, we're interested to see cycles from year-to-year basis. That means we have to find out where the cycle ends and where the cycle starts. The approach I'm going to give you today is an approach that is mostly used to predict certain cycles on a weekly basis. However, going down to 15-minute chart, implementing new tools into our chart will give us more ideas how we can speculate as day traders. That, ladies and gentlemen, will be our first quest today. The first thing that comes to mind is why weekly chart? It is very important to understand that the tool that we're going to use, it is better observed and better systemized with better inputs by looking at a weekly chart, by finding where are the two recent lows and calculating their average on a 3-cycle base. What I mean is that the indicator, or the more better formulated, is the oscillator that we're going to use is the commodity channel index. The commodity channel index, as I mentioned, is an oscillator tool for trading cycle trends. That leads us to believe that for our long years of research, it is a very good substitute indicator for Elliott waves. Now, I've had many conversations with a lot of traders here in the firm. A lot of them are investors. Most of them are traders on day-to-day basis. And their understanding about Elliott waves differs from one to another. So the chart is one and the same. They're looking at one and the same instrument at one and the same time frame. But the way they are actually predicting the cyclical waves differ from one another, which means one of them is very successful. The other one is just making profits and losses only to stay on the under the radar, let's say. And the third one, for example, is making huge losses. Because the analysis you guys are making is always different. There is no one and the same analysis when it comes to Elliott waves. But I'm not going to talk about Elliott waves. Mostly I'm going to focus on the today's system. Our approach is starting from the weekly chart. Why the weekly chart? It is understanding that we need to implement into our brains that the commodity channel index uses a measurement in relation between price and moving average. So, more specifically, normal deviation from that particular average. The actual commodity channel index calculation is a formula which you don't really need. So basically you have a visual experience of what the market is doing, the cycles that are predicted. The one calculation, the commodity channel index, is determining a time interval which plays a key role in enhancing the accuracy of this commodity channel index. So, since it is trying to predict a cycle using a moving average, the more attuned the moving average is, that amounts to the more accurate cycle prediction. The more accurate the moving average is, the more accurate the cycle prediction comes. Now, this is true for most oscillators. So, even though traders use the default settings of 20, for example, it depends actually on the chart that you're using. So let's have a look at the commodity channel index here. It goes on the custom. If you can see, CCI is the abbreviation for commodity channel index. If we implement it on levels, we will see levels from -100 to +100, and of course the zero level. However, on inputs, we have the value or the period of this commodity channel index. Now, a lot of traders are using usually the default settings of 14 or 20 or 30. It depends on the MetaTrader 4 where you actually downloaded it from. But if you get it from our website, this is the actual value that you're going to get. It doesn't really matter which is the default settings, because the time interval for commodity channel index has to be calculated. The more accurate time intervals reduce the occurrence of false signals. Therefore, the simple step to determine the optimum interval for calculation is the following. Weekly chart, ladies and gentlemen. So let's just implement this commodity channel index so you can visually see how it looks like. These are the levels, -100, 100, the zero level. You can also add a zero level here. I will show you later because we're going to use it on the 15-minute chart. But right now, we need to determine what would be the value of the CCI, making our first step into our swing trading system. The correct way to find out from the two recent lows, like two bottomings here, is on 2015, that's March 15, and the extremum of November 29, 2015. The last low was here, and we have to find out how many candlesticks. Those are 37, which means we have 37 weeks. To find out how many days, we have to multiply 37 by 5, and we will find 185 days of trading. We have to divide the time intervals by 3 to get the optimum time interval to use in a calculation. That means 1/3 of a cycle. And these 180 days, 185 days, we divide on 3 to get 61.66 in period in value. However, it is not necessary to input 61.66 in period. We can only just go for 62 in value or 61. It works pretty much the same. But for me, I like to smoothen out a little bit better, so I'm going to set it up on 62 in value. Before I do that, let's have a look on this long trend, long cycle here. Okay, it starts with this bearish candle. And you can see this is where the commodity channel index is, on the value of 14 in this stage. At the end of the cycle, we can see that the commodity channel index is somewhere on -149, but using a value of 62 in this case, just have a look on how the commodity channel index looks like afterwards. You see, the commodity channel index is following the trend and the cycle itself. So, first, how we can trade this particular cycle on a weekly basis. This is what investors are doing when they're using commodity channel index, which is actually developed for commodities, but it can be used on currencies as well. Especially works well on currencies because their cycles are extremely long and productive, obviously. Now, on this particular candlestick, now we can see that our commodity channel index stays on the level of 100. It breaks the level of 100, which is our trading signal, but we enter on the second candlestick here, where we already see that the commodity channel index is well below the 100 level and is actually starting a new cycle. And our exit is when the commodity channel index breaks the minus 100 to the upside, and it closes with 1 week. So let's say investors are doing only that particular analysis, and their particular profit in this case is about 2,323 pips in value in 52 weeks. That's 1 year. 1 year you have a profit of 2,323 pips. With one lot, only one lot, that's $23,230. Okay, imagine if that's 10 lots. That's 233,000. And 10 lots, everybody knows that you need about $7,000 to $10,000. Now that is an amount everyone can get, especially because you're a working person, for example, or you're trading for a living, which is even better, and the money is not short for you. And even if it is, you will very quickly build up on this portfolio and start expanding to different currencies. So for 1 year, with 100 lots, put it this way, you've made $2.5 million. And this is actually the most conservative way you can use that particular commodity cycle, commodity channel index on this cycle, because you don't really exit on the bottom here because you don't know if it's actually going to continue going with this cycle. So you're waiting for a breakthrough over here. Usually the price retraces, so if you're greedy enough, you might even get about close to $3 million for 1 year. I know that everyone would be tempted by the word millions, but let's be a bit more conservative, because everyone is starting from somewhere and nobody starts from the top, for example. Everyone starts from the bottom. So let's say you have the opportunity or the possibility to trade with one lot. So for 1 year, ladies and gentlemen, you're actually making, with, if you had a $1,500 account, or let's put it $2,000 account, and you're comfortably trading with one lot, you're making $20,000 in 12 months. Now, this is pretty much $1,600 average every month, which basically you're doubling your account every month. Well, that is a good example. However, what I wanted to stress on here is that this is our first approach, how we can actually start using the system by implementing the commodity channel index, and not only by specifying it to determine much more accurately the beginning and the end of this cycle, or any cycle, and then we have to move forward. That means we have to go down a notch, go down to a daily chart and see what's happening there. So our analysis is, as per we're starting right now, we've never heard of this particular system. We're starting to implement it in our chart. So the accurate way of doing so is using Fibonacci retracements, but not the normal Fibonacci retracements. We are going to use Fibonacci fan. This is something we haven't shown so far for you guys. It is a very good tool, especially in connection with the commodity channel index, simply because we know that the commodity channel index, already we found out that is a measurement with the relationship between the price and the moving average. So we have specified it for much more accurate deviation from that average by equalizing to 1/3 of a cycle on a weekly chart to find out that our period should be 62 in this case, or 61.66 in period, obviously. However, we can see that even here on a daily chart, ladies and gentlemen, this cycle is very accurate on the commodity channel index. So this here for 40 days, 40 days, doesn't matter. It's nearly 800 pips in profit. And this is from the beginning of this cycle, which is from here on the breaking. This is the opening of the new candle to the closing, which is over here on this candle, is about 738 pips of profit for about 40 days. That's 2 months, ladies and gentlemen. 2 months in trading days. That's every month by 20 days. So these cycles are very well used. I do understand that cycles like these are also a problem because these are the false signals here. However, the commodity channel index follows the cycle itself. So once the cycle begins, let's say here, it is very difficult to make a mistake. Let's say about 90% certainty is what you have that the cycle is likely to continue, because the commodity channel index is giving you overbought and oversold conditions in a much more accurate way. And the complexity, of course, with the commodity channel index involves the fact that you should not take the signals that you're receiving, or what you ever want to call it, from the commodity channel index literally. Basically, you have to just keep it as an understanding that a new cycle has begun. My trading plan suggests that I should follow the trend, let's say, because you might have a trading plan that suggests, counter trend trading, which is also another system that in the future, of course, I will present to you. I've got a lot of these. They're very profitable. However, it is extremely stressful to trade such counter trends. Right now, I want to focus on a particular cycle. So we have this large trend here. Now, using the Fibonacci fans over here, insert Fibonacci, drop-down menu, fan, and expand it to the end of this trend. Now, this is how we actually begin our analysis. And this is a way where you can get a very, very accurate support and resistance levels, and you don't have to delete it, especially on the daily chart. So that's what I meant by starting to use that strategy. So you have to begin from somewhere. That's why you have to gather a bit of a data by implementing Fibonacci fans on the oldest trend that you can find on a daily chart, and then on the next trend, which is again short-term uptrend. One more time, we get the new cycle here, extend it over there, and this is what we're getting. Another Fibonacci fan that you can, of course, paint it in different colors, but that's not important, for the very simple reason that the only thing we need from those Fibonacci retracements are the actual support and resistance levels, which come in handy in a small time frames later on. Now, we're getting the latest crossovers, which are here, those 3 lines. And those 3 levels are, in this case, strong resistance areas. So basically, once the price crosses over a resistance area, then your new swing high has been formed. and you can wait for a retracement down to the same very level to hit a new long position in this case. However, if we have, for example, a level that is lower here below the price, now that represents our support areas. Now let's get some new properties in these support areas. Of course, I will just mark it as long green or just green. It is by default, it comes by suggesting that resistance comes up, that's why it's red, support comes down, that's why it's green. But you can actually replace these colors any way you see fit. And here we have crossovers, ladies and gentlemen, that happened very, very long in the past. Let's say this trend has been over and now we're here somewhere. Okay, imagine this. This is September 3rd, 2015. And until today, those levels are super accurate. You can see how the price is swinging between these levels with a very huge difficulty in passing through. It is also good to get the final crossovers over here. I will show you why. It is good to have much more levels. You can see one more time, let me zoom you in on this. You can see how the price is bouncing off very accurately up from these levels, as well as over here, you can see the support and resistance acting, corresponding pretty well with those lines. This is what Fibonacci fan is mostly used by the traders in our firm, by myself. In trends, in cycles, you can also, of course, use it as retracement levels. Let me zoom you out one more time. You can see on the 61.8 that the price is bouncing pretty well with a confirmation on a close. You can see the retracement and then a very strong bullish movement in the next 3-4 days. This is also what traders are mostly using the Fibonacci fan. However, those particular trend lines, as a fan, I've been using for many years to determine support and resistance levels, and of course the pivot points, which is actually one pivot point on a chart. So in a daily chart, our pivot point here comes in between the last or the first support and the first resistance level, which of course an average is somewhere here. And this you can actually mark with different color. I usually choose white as a, let's say, as a neutral level, somewhere where the price is expected to reverse up or down. And in these cases, I usually remove those which are very close to this particular one. And this is resistance number 1, support number 1, and this is what we have. We have very good levels that you can use for trading. How? We will see a little bit later. Also here, what is important to get is that we have to remove this particular trend line, support level, because this one and this one are particularly close to each other. And leaving this one and this one, like this, for example, gives us a little bit more room to trade, or let's say, gives us a bit more, distance to make our projections for profits and stop losses, so on and so forth. So these are the levels that you can use. Now, why we're going down to another particular chart is to get another cycle, and this is on the 4-hour chart time frame. Now, those two, you see, they disappeared. The only thing that you see here are just support and resistance levels on a 4-hour chart. When you switch back, you can see this, those two Fibonacci fans that you've been using. They're not going to make you any problem. They will be there until you are trading, until you decide to remove them, or you accidentally, your computer shuts down because of a power surge and you have not closed the MetaTrader 4 to save those. This is something that I recommend. When you do something, save the settings, because then you have to start all over again, and that's not very pleasant. So, moving down to 4-hour chart, ladies and gentlemen, to get a bit more cycles here. Now, here we have a very bullish cycle. We can see from the commodity channel index, it starts from the bottom, finishes there, and then retraces back down to hit the positive 100 level to the downside, which means we need another Fibonacci fan from the lowest extreme here to the highest point of this particular cycle, which is over there. Please note, ladies and gentlemen, we're getting also the extremums, not only the closing and the openings, but with the extremums, the whole price hike, everything that the price action has actually done. We need this to better determine those support and resistance levels. And as you can see, every time the price is up to cross a Fibonacci fan level, it is facing difficulty, support, 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 until it breaks it off and starts a new cycle. Now, with this new cycle here, we need the other cycle, which starts from here and ends down here. Now, why I'm choosing this one and not this one? Because it is obvious that this cycle retraced more than 50%, which is marking the actual end of the cycle, and we can determine that, by using the commodity channel index to determine the beginning and the end of this cycle. So it is here, you see, the beginning is over here when the commodity channel index breaks the 100 level, and the end of the cycle is when the commodity channel index breaks the minus 100 to the upside. So we're taking from here to the extremum down here to determine our next Fibonacci levels, like this. Now, in this case, ladies and gentlemen, we're not going to place any particular support or resistance levels at this stage. Those that we have so far are our major supports and resistance. So this is something that in the future, when the time comes, have a look, bringing it down to 1-hour chart, we will start seeing, for example, when the price starts climbing up, and then this level will occur, and we will know this is a very important resistance level. If the price bounces off from there, we can expect the price to come down a little bit. So then we're making something different. So let's get back to those Fibonacci levels here on the cycle that the commodity channel index suggests, because we can see those cycles here are not very straightforward. This cycle, however, is making us to take a look at it. That means we need to add another Fibonacci fan. From the beginning, one more time, I'll conserve a little bit of time just to go straight forward to the end of the cycle, like this, and then from the beginning of the new cycle to the end of it. With the extremums, please. Here we go. Now, why I've done that is because when we set these previous levels now on a smaller time frame, this is 1-hour chart, we need these levels much more accurate. Now we see that those levels are pretty close. So if I set up another level here, it will be too tight, and basically it's pointless to set it up. However, the older it is, the more a larger role it actually going to play in the future. So we're mostly interested in going down to 15-minute chart. So on 1 hour chart, let me correct this one to the appropriate. Now we already know where the pivot point is, so we're not going to touch it. Everything below this major pivot point goes green, the other one on the top goes red. I suppose you understand what I mean. Another horizontal line we're setting up on the second one here, which is this one. Another one we're setting up over here, and another one goes over here. So now we have levels. Every level by about 15 to 30 pips in distance. You can see this one is about 20, this one is about 15, this one is about close to 20. Those levels are by far enough for us to go down to a 15-minute chart. That means that the recent Fibonacci fans that we've made are no longer useful to us. Of course, I have totally forgotten to set up the upper side crossovers. These are the resistance areas like these. So we have one important, which is the crossover here. This one is too close to the pivot point, so we're not even going to consider it. Therefore, these Fibonacci's are no longer useful to us. Please note that particular levels like these, depending on the swings here, as we can see, this is a major sideways direction since the beginning of the year on the euro dollar. So that's why we see the previous levels corresponding with the latest drawings that we've made. But in a longer cycles, so longer directions, short-term directions, we're actually going to see much more deviant levels one from each other, and this will give us a bit more of a direction. But right now, as we mentioned, we have a sideways direction, and the system also allows us to use these implementations to trade that trend. Going down to 15 and accordingly prepping it for our trading. As you can see, there is a lot of support areas coming very close here. You can see that the levels that we've drawn, when we actually start following, you see how accurate they're actually corresponding. Well, this is pretty much because of the cyclical usage of the commodity channel index and the Fibonacci fan that actually gives you the possibility to chart with crossovers those particular cycles by giving you support and resistance areas which are very strong, and once broken you can see new swing lows on that 15-minute chart. So right now we can see that the price is swinging between the pivot and the first support area. When we see a breakoff and a confirmation of this one, we're taking a long position for a first target at 1.0958. Second target comes over here. Let me have a look at 10.43. And of course, for longer time periods, 11.23, 1.1123. Of course, if by any chance we see, sorry, don't get confused, on a small time frames, this is the ask line here. So this is the ask, this is the bid. I'm usually using both because I need to see how the spread is changing. Based on that, I can determine what is the current volatility on the momentum, and the price action follows. There is a little bit of technique here when I mentioned the both lines. I don't know if you guys are familiar with this, but the first price that moves is actually the ask price. The ask moves, the bid follows. The ask moves, the bid follows. Just check it on a small time frame, smaller than this, of course, and you will see that on major actions, you can see that the ask price is moving, then it's followed by the bid price, because there has to be someone that buys something first to be able to sell it after. The law of physics. Without getting too metaphoric here, I'm just going to mention that once we see a confirmation below this level, we can just go straight forward to our final target, which is over here. However, you can see that there is a long empty space here, also between this one and this one, which means that in this case we have missed something that is very important, and there is a level that stands somewhere between here, which is one of our targets. Therefore, this is how you're actually going to determine what you've missed, so you can trail back and start all over. Take a look at our Fibonacci's, see if we've missed something. We can see that our levels here are pretty okay. We're going to go down to a 4-hour chart time frame, see where we've missed something. We can see that those levels are mixed up a little bit. So while I've been zooming out, so you can see the larger scale of this particular system, we have actually yet to reconfirm a bit better those particular levels, so we can have much better accuracy. And when we go down to 15, we can see that there is still something missing, and we need to go to 1-hour chart time frame to find out that there is another cycle here that we've missed. Now, in order to get the better of it, we need to take another cycle. You can see the start of the cycle here. The small cycle finishes here, and then the cycle is actually over here, is over on this particular break-off. So we're going to get the whole cycle, and the next cycle that starts right over. This is the 100% retracement. We get another Fibonacci here to see what we've actually missed. We have 3 very close levels here, so we're actually going to take the one that is further away from our previous, like this, and 3 very close levels. We're going to take the final one further away from our previous. Get rid of these Fibonacci's one more time so we can simplify our particular chart, and go back down to 15-minute chart to see that those levels are a little bit better this time, which suggests that once this level has been broken here, we can see an immediate direction down to that level, 0.88, which is a very familiar level in the past a month and something and a half. I believe that the price was swinging around this level for quite some time. So this is what the system is actually based on. First of all, you start from weekly chart to get the cycle right. We're getting the cycle, 2 lows, one here and one here. 1/3 of a cycle gives us the actual input of the commodity channel index. Bringing it down to smaller time frames, we can see where exactly the cycle is starting, where exactly we're going to take these particular levels from. Also going down, still checking on the cycles until we get down to 15-minute chart so we can start trading. Sometimes when we have strong moves, trend which is established very quickly and picks up very quickly, It is a very good entry level on candlestick formation. You can get from the 5-minute chart. So in combination of 5 and 15, you can get a very good price entry. That's all about the strategy, nothing complex. Also, I will remind you that I have had this strategy or system, whatever you want to call it, recorded in a couple of days' time. We're going to refine it. We'll master it and input it into our YouTube channel so you can review it one more time and see what you've missed. Meanwhile, whatever questions you might have, please send it directly to my email or to webinars@gdmfx.com, or just go to our website. Over there, you can forward your questions directly to the support department, and if the colleagues there are not able to answer your questions, if they're more complex, then they need a bit of a on-time and in-depth approach to solve the case you have, we will take over as soon as possible. And if you have any major issue, our telephone line is always open for any questions or any problems, whatever you want you need, forward it there, and we will be right there with you. Thank you very much for joining us. Let me remind you that this Friday, I've left it for Friday because there is a trading system that we've been using last year, and it is involving moving averages, which you can implement along with this particular system. So we're going to use the same charts, for example, and see how exactly we can input this. It's not a second part of today's session. You can also use it as a separate basic trading system, but it's been revised. So the values of the moving averages are a bit different. We have revised it according to the current market conditions. So please join us. See what you've missed and see what we've corrected from our previous systems. This is the only one we've corrected so far, and it's important for you to know it. So our other webinar sessions will be in a connection to the new trading systems that we're talking about. We're going to implement some new trading tools like the average true range. We're going to talk a little bit about the Ishimoku systems that you can use, and standard deviation. Along with this, I also am working on a very good trading systems that will actually simplify what we've told you so far in today's session and give you the actual, let's say, a tool that you might going to use very good into your trading system, but it's very strict trading system into timing, so you need to be very accurate into opening your positions in different time variations. Let's say you open a position today and you have to open a new one for sure when the time comes in 2 days from now, the next one 4 days from now, the next one 6 days from now. You see, this is a cycle that this system incorporates. So we're not really interested into seeing what the fundamentals are. In this case, we're actually only relying on only technical systems. So if you have not joined to all of our sessions this month, do so you don't miss on the greatest opportunity for new trading systems. And yet again, it was a pleasure for me to lead this first webinar for this year. And thank you very much for joining us. See you next time. And of course, have a performance, beautiful performance this year, and I wish you all the best. See you next time. Bye-bye.